So when we founded the business back in 2008, if you looked at the investment landscape back then, you would find that a lot of portfolios looked very similar. A lot of managers did things, thought about the world very similarly. There seemed to have been a lot of groupthink, and very few managers, frankly, were willing to really stick their heads out. And we thought, well, let's go and do something that is completely different to what others are doing. So the emphasis not just on a little bit different, and not just pay lip service to being different, but to actually being very, very different. And that permeates all throughout, all levels of our company. And it starts with the name. So the name Contrarius is, it's pretty explicit. It's a commitment or a promise we've given to our clients that this is what they should expect. Our company is owned by the staff, myself included. Senior staff are all shareholders in the business, and we've all bought into this contrarian philosophy. We don't manage any other products. We have a global equity fund, a global balanced fund, and we have 2 regional funds, and that's all we do. So there are no conflicts of interest. We hire people that are independently minded, that are inquisitive, that think about the world differently. So again, it's sort of very deeply embedded in our corporate culture. We then separate our research team, so we don't all sit together. We have a team of analysts doing research in various offices throughout the world, in Jersey, and here in London, in Bermuda, and that is to combat groupthink that we often see happen in asset management companies. When we do research, we don't meet with company management. We find that potentially clouds your judgment and your objectivity. We don't rely on sell side or other external research. All our research is done 100% by our in-house research team. It's all proprietary. We don't share it with other people outside of our company. We are very long-term focused in a world that's increasingly short-term focused. You've got pot shops, you've got algorithms and AI things doing like short-term trading. We've very firmly stuck to a long-term focus. And then our product range, as I said, is very, very simple. So throughout our business, we try to do things as differently as possible. And I guess at the end of the day, the proof is in the pudding. When you look at our returns, you can quite clearly see that there is no correlation between our returns and that of the broader market or of our peer group. And there's also no overlap, or a very kind of low overlap, between the shares we own and the shares that most of our peers own. Our portfolios look truly different. So, I mean, we wouldn't want to be pigeonholed, and we certainly wouldn't want to paint ourselves into a corner. I think if you had to push us, we probably would say we are value investors. But when you look at our portfolio, our biggest 2 shares are Tesla and EchoStar, and you won't find those 2 companies in typical value manager portfolios. We are equally comfortable owning a high growth business like Tesla or EchoStar, which owns a stake in SpaceX, as we are owning slower growth companies like British American Tobacco or Pernod Ricard or Diageo, as we are holding a mining stock, a cyclical mining company, for example. And I think it's really that sort of open-mindedness and we completely ambivalent as to what factor this potential company might fall into, or sector, industry, geography. Is it growth? Is it value? I think we're pretty open-minded. We want to go where the opportunities are. There are times where value shares are very expensive. Traditional value shares we think are very expensive, and you would probably at those times find our portfolios tilt more toward growthier type stocks. And there are times where growthier type stocks become expensive, and you would find our portfolio tilt toward value. So we certainly, as I said, wouldn't want to paint ourselves into any corners, and we would always want to be open-minded and mentally flexible to be able to go wherever the opportunities are, be they value, be they growth, be they quality, etc. Tesla, then EchoStar. Our third biggest share is Alphabet. Those are 3 companies that we think would be big winners in an AI world. But then our 4, 5, 6 largest share is Diageo and British American Tobacco and Philip Morris International, which are liquor and tobacco stocks. And those have nothing in common with a rapidly growing sort of artificial intelligence company, a company that does online search or has large language models or sends satellites into low Earth orbit. So we are completely open-minded. And I think that's what makes us unique, is that you would find companies in completely uncorrelated sectors, industries, and with completely uncorrelated drivers or factors next to each other in the same top 10. We think our top 10 is truly unique. I certainly haven't seen anyone with the combination of shares that we have. Yeah, it's very interesting. So we broadly look at the market as falling into, let's call it 3 big buckets. The first bucket is companies that we think will benefit from AI. These are the AI winners. Now, I will maybe take a step back and say that a lot of value managers have missed out on this AI sort of rally. We've done a lot of work on AI over the last 3.5, almost 4 years now. Our conclusion is that artificial intelligence is not just your average run-of-the-mill disruption or innovation that comes around every 10 or 15 or so odd years. We think this goes way, way deeper than that. We think this is a fundamental reconfiguration of how knowledge work is performed. And we think it will have profound implications on broader society, on the structure of economies, etc. So we think this goes very, very deep. Now, in this bucket, our goal, of course, is to benefit from shares that will benefit from this changing technology. And we have been very active in this space over the past few years. I will say with valuations, especially AI-related stocks having gone up a lot in the past, we've taken some money off the table and have basically narrowed down the shares in this area to the ones that we have the highest conviction in that they will be beneficiaries in future. I will say in this AI space, one has to be extremely nimble and willing to change one's minds, given the rate of technological disruption that we are seeing. I mean, things are changing at warp speed, and you have to be able to move on. And so we've reduced our holdings in this kind of bucket to basically at the moment the 3 shares that we think will be the biggest beneficiaries, and those are Tesla and EchoStar, which owns a stake in SpaceX. And that's really for the lead that these 2 companies have in real-world artificial intelligence. So not large language models, but actual real-world, whether it's robots or cars that drive themselves. You go to Austin, Texas now, you'll see Tesla cars driving with no one in the driver's seat. And we think we are in the very early innings of this. And in a company like Tesla, you are benefiting from the convergence of electric cars, autonomous driving, renewable energy, and in SpaceX, of course, you're benefiting from the fact that more and more things can be done through sort of low Earth orbit. And so we think these 2 companies have a massive lead on the competition for various reasons and will be big beneficiaries going forward. So that's the first bucket. As I said, we've taken some money off the table in this bucket and allocated it to the second bucket, which are companies that are AI-proof. So these are companies that won't be disrupted by AI over the next 10, 20, 30 years. And you'll note that we are thinking very long-term here. So our horizons at this point in time are fairly long. Now, in this AI-proof bucket, you would find companies that have strong consumer brands, tobacco companies, liquor companies. These are companies often that have been around for many decades, even centuries in some cases. Luxury goods businesses like LVMH or the Swatch Group is currently a reasonably big position in our fund. Swatch, of course, owns a number of luxury watch brands like Omega, Blancpain, Breguet. And in fact, for most of our company's history, these types of shares were very expensive and were loved by quality investors. And it just so happens that at this point in time, valuations on those shares have come right down. So you can buy companies like British American Tobacco. Diageo is down 65% from its highs. Same with Pernod Ricard. British American Tobacco is no higher than it was sort of 10 years ago. Philip Morris, Altria, Imperial Tobacco. These companies have been very weak, and you're paying 10, 11, 12 times earnings for companies that we think have defensible businesses, solid, stable, cash generative, and won't shoot the lights out, but will be slow growers, which we think will be a great outcome in a world where many companies get disrupted by AI, and where you look at financial markets now, with the S&P trading at sort of 90th percentile levels of valuation, we think this is a great place to park one's money over the long term from here. So that's the second bucket. And then the final bucket for us is, and this is one that we spend actually a lot of time on, and these are companies that are not owned by the fund. These are businesses that we think will be disrupted or there's a very high probability of them being disrupted by AI. And in fact, many, many, many companies in the market fall into this category, unfortunately, whether it's a company that produces internal combustion cars, whether it's a company that sells insurance on internal combustion cars, whether it's a financial services business that does lots of cross-border or remittances, things that can quite easily get taken out by stablecoins or by various blockchain-type technologies. Companies that, companies like Lyft or Uber that we think face a serious risk of disruption over the next 10 to 15 years, with companies like Tesla providing autonomous taxis and probably using their own interfaces and their own apps. We think there's a massive risk of these companies being disrupted. And there's unfortunately a long list of companies, and we've been pretty paranoid about not touching these companies that potentially would be disrupted, be it software as a service companies, all these middlemen who make a margin in the middle. In the world of agentic AI, the agent can go directly to the source, cut out the middleman, save the end client 30 or 35% in some cases. So these are companies that we are very, very wary of, and would, I guess the challenge for us is, in many cases, these companies are down 60, 65%, and there's a big spotlight on those companies at the moment. And our challenge is to remain disciplined and not wade into these potential value traps that now might appear cheap on the face of it, but could be gone in 4 or 5 years' time. So we're pretty optimistic about the outlook for our fund, especially in light of the sort of AI disruption that we can see happening. We are finding good valuations on companies that we think are AI-proof, and then we think we are able to identify the AI winners. Of course, we might change our minds on the composition of what's in these buckets over time, but we're pretty optimistic on our ability, certainly, to outperform the benchmarks from here.